Hello and thank you for joining me today. My name is Wesley Boudreaux, one of the financial advisors here at the Retirement Group. Today we're going to talk about the Merck pension plan and interest rates and how it affects the lump sum calculations, especially in this rising interest rate environment. And we'll talk about how the pension is calculated and touch on the different options that you have for the pension distribution strategies once you decide to leave Merck. Now, before I get started, I just want to remind everybody that the Retirement Group, we're an independent financial advisory firm. We do not work for, nor are we endorsed by Merck. However, we've been working with employees, helping them transition from Merck for quite some time, so we've got a good understanding of the benefits plans, whether it be the 401k, the pension, healthcare, all those different options, and how to essentially hold your hand through that transition, make sure that you avoid a lot of common mistakes we see from time to time. Now, if you need to sit down with somebody face-to-face, we still have offices throughout the country, so rest assured we can take care of that for you. However, we can obviously do webinars or web meetings, phone calls, emails, all of that's available as well. And at the end of the day, if there's anything you take us up on, it's our complimentary cash flow analysis. If you have not done one recently or ever done one with us, if you can spend about 5 to 10 minutes gathering some data with us, give us about a week, we'll put together a pretty detailed cash flow analysis to show you, are you on the right pace to meet your goals, whether it be retire this year or in 5 years, or whether you want to look at alternatives, whether you want to retire earlier or do you need to work longer. There's all kinds of different things we can run through there and especially show you on the pension choices we'll talk about here in a moment what the best choice will be for you and show those side by side and how they look not just now but in 10, 20, 30 years down the road as well. So when we talk about the pension, let's talk about some of the different things we'll go through. We'll first focus on the eligibility, who gets the pension, talk about some of the age penalties associated with that, your distribution options like I mentioned before, some of the basic formulas for management versus hourly, and the interest rates and how those could affect you on the lump sum conversion option. So first and foremost, who is eligible for this? You need to be there for at least 5 years to become eligible, but beyond that, you need to be there a little bit longer for some more flexibility. What you need to remember in the back of your mind is 55 plus 15. Once you reach age 55 with 10 years of service, then you are eligible for the lump sum option and not just the annuity. Now, if you do retire and decide to take that pension at age 55 plus 10, then you're going to have a reduced benefit. However, if you wait until age 62, that's when the full retirement age is going to be, and you get 100% of your pension, whether it be the lump sum or the annuity. Now, if you didn't make the 10 years, let's say if you got hired at 59, you work 6 years, made it to 65, then you'll get 100% of your pension at that point in time as well. Another caveat to remember is if you left, came back, and have a bridging situation, age 49 is where that works, where you can maintain the pension in there as well. So we mentioned 55 plus 10 is what you need to focus on, but how much of your pension will you get? If you're not age 62, you're not going to get 100% of it. If you decide to commence your benefits, that doesn't mean necessarily leave, but commence your benefits prior to age 62, there's a reduction of a 1/4 point per month, so essentially 3% per year if you go earlier. So if you were to take your pension at age 60 instead of 62, it's going to cost you 6% in penalties. If you go as early as 55, which is the earliest, that's going to be 21% reduction there as well. And then also keep in mind those penalties. Just because you retire doesn't mean you have to take your pension. You can avoid those. So let's assume maybe somebody retires at age 50. At age 55, they don't have to turn it on and take that pension immediately. They can actually defer that out to age 60 or 62 if they want to maximize their pension. Now, when we get to the next couple screens and look at the pension options, there are nuances as to whether you're taking the lump sum or the annuity, as to whether it makes sense to defer or not, because you've got to focus on both the age penalties and potentially interest rates and how they affect your lump sum calculation as well. So as far as those options you have, again, this across the board for hourly or management, it's going to be a formula that's going to determine what your single life annuity is going to be. So the amount that Merck would have to pay you for the rest of your life. From there, you can deviate and look at the different choices, but everything's built upon that. Whether you want to look at a joint survivor annuity, so you make sure your spouse is protected so that he or she can get payments at either 100%, 75, or 50% continuation. Whether you want to add a period certain so that if something happens to you earlier in life, you know that's paid out for at least 5, 10, or 15 years. And there's also a unique Social Security leveling option where if you retire before 62 or 65, you want to make sure that you get the highest amount you can get. What will happen is they'll give you a higher income prior to Social Security turning on. Then once Social Security turns on, they'll drop that benefit. So essentially, let's say you start out with $3,000 across the board. you'll get $3,000 from Merck, and then let's say if your Social Security kicks in for $1,000 a month, they'll drop the annuity down to $2,000, so you continue to get that $3,000. Now, the lump sum is actually what they have to do is they use interest rates. They look at the Pension Protection Act segment rates to determine what amount are they going to give you for you to essentially go out there and try and recreate the same annuity stream yourself. And we'll talk about those interest rates in just a moment. Now, first, before we get to that, let's talk about the formula. This is the basic formula for non-hourly, and essentially what's going to happen is it's broken up into two segments, before and post, pre and post 1995. Before 1995, it was a 2% multiplier. Then they changed it to 1.6% after that. And then what they're going to do is they're going to claw back or offset Social Security. So what that means is they've been making putting in half your Social Security while you've been employed, so they're going to subtract that back out of the pension equation. And once you go through all those numbers, that's going to give you what your annual lifetime income is going to be, so your single life annuity. And then from that figure is where you calculate all the different options like we mentioned before, the joint survivor versus lump sum. As far as the hourly, it's actually two different formulas that you're going to use, and it's going to be either the minimum benefit formula or the career average earnings. And the great thing about this is you don't have to go through there and nitpick on it. They will actually run this calculation for you side by side, and they'll determine what the best option or the highest option is going to be for you. But let's look at the minimum benefit formula. It's very simple. It's just essentially taking $55 per times the years of service that you've had with the company and figuring out what that minimum would be. So if somebody in this case was 65 with 35 years of service, it's just simply 55 times 35 years of service to equal that monthly. Or if you want to multiply it by 12, give you the annual salary or annual income you'd be getting would be $23,100 in this situation. Now, the career average earnings gets a little bit more complicated, and but to give you kind of a quick look under the hood, the way that works is there's actually a couple different variations to it, but it varies based upon your level of income. And what they do is for the years after 1999, there's a 1.25% multiplier on the first $4,800 of earnings, and then it jumps up to 1.5% on earnings above that. But then 4 years prior to 2000 or prior to 1999, it was 1.25% of the average of the 18 highest wages between 1980 and 1999. It's a little bit different, but again, 4,800, and then once you go above that, you're looking at that 1.5% multiplier, and it's all based upon your credit services earned in 1999. So again, you don't need to necessarily know that, but when you run through the calculations, you'll see those side by side, the different choices that you have. And going back to lump sum, as I mentioned, the way that actually works, you take that single life annuity, let's assume it's $3,000 a month for the rest of your life, for instance, and then you look at figuring out, okay, if I want to try and recreate that, how much is Merck going to have to give me to do so? What they do is they look at your age, and they look at life expectancy to figure out how many more years or months they have to pay you. Then they go and look at the interest rates to determine what that calculation for the net present value is going to be in order to give that to you. The interest rates they use are going to be the Pension Protection Act segment rates, which have three different interest rates. There's the first segment, which covers the first 5 years retirement. Second segment is going to be years 6 through 20. And the third segment, years 21 and beyond. So for most of us, that middle segment is going to have the highest weighting because it's going to cover 15 years of retirement. And then what's going to happen is they're actually going to run those projections for you, or excuse me, run those calculations and determine how much are they going to give you for you to go out and recreate that. So when interest rates are lower, they give you more money to go out and try and recreate that annuity. When interest rates are higher, they don't have to give you quite as much. And we're in a pretty unique environment where the last couple of years, interest rates have been on the decline due to the pandemic. But now inflation is setting in, it's rising rapidly. So we're going to see some major changes here between 2022 and 2023 for most of you, especially those of you who are hourly. Your calculation is just on an annual basis. They look at the October rates. And if we just looked at October rates last year, which gave you this year for 2022, and we look at how much the interest rates have gone up already, they've already gone up by over 1%. So what that means is if you're looking at your lump sum right now, it's going to go down by at least 10%, if not more, next year. So if you're thinking about retiring in the next year or two, it's really important to give us a call to run those side by side and see if it makes sense to even work into next year or to go earlier so you can maximize your pension lump sum. And then for management, non-hourly, it's going to be on a quarterly basis, so there's a little bit more flexibility there. But again, give us a call to run your numbers. The jump from second quarter to third quarter right now is pretty strong, and if things continue, it's going to continue to climb from there as well. Now, again, like I said before, to make it easier, you can actually just run the pension projections online. You can call On Point at 866-637-2543, or you can go online to merck-db-buckwebsolutions.com. And like I said, you can go through there and run the pension calculations. Once you get those numbers, then give us a call. We can run those for the cash flow analysis and show you the comparison of all those different options, or you can just provide us with the PDF of your estimate, if you would, as well. And so ultimately, like I said, the best way to kind of understand what your options are is going to be putting this into a plan and running that cash flow analysis we talked about. Right now, about 3/4 of Americans out there, over 50, don't even have a written plan. If you can spend about 5-10 minutes or so with us gathering some of the data and answering some questions, we can give us about a week. We'll put together that detailed report for you, and we'll be able to show you variations, whether you know when you want to retire and make sure you're on the right path, or if you want to look at variances of retiring earlier or taking a part-time job somewhere else. We can go through all those different options and show you what the pension, the annuity versus lump sum may look like side by side, not just now, but in 10, 20, 30 years down the road as well. And then at the end of the day, obviously we do a lot of work with Merck employees, and we'd love to work with you as well. If you're working with somebody right now, that's great. We do recommend getting a second opinion. We even recommend our own clients do this periodically just to keep us on our toes. But you want to make sure if you're working with somebody, they have a deep understanding of the company plans so they can help you avoid mistakes. Countless times we've worked with individuals who had a long-term financial advisor, but they just didn't know the plans, and they made mistakes still, even though they thought they knew what they were doing. And at the end of the day, you're going to have fees, whether you keep things in the 401k plan at Merck, whether you roll over to an IRA, work with us, work with somebody else. Just make sure you understand the fee structure. We're fiduciaries, so we're transparent on that. Our goal is to actually back into choices for you and give you those options, whether it be as simple as a DIY approach you do with through Charles Schwab, or whether you want us to manage the account for you as well. We can go through all those different options. And at the end of the day, figure out what it is that you're looking for, and make sure that the firm you're working with has a strong focus on that. Make sure you're working with a team. One individual can't do everything all at once. It's very difficult to do that, especially in this environment. And then make sure, again, you run that cash flow analysis. If you haven't done so, you shouldn't be looking for a recommendation from anybody until you have a deeper understanding of what your overall plan is and what you're trying to achieve. And so with that, I want to kind of wrap this up. But again, remember, everybody's unique, so give us a direct call, and we'll be happy to walk you through the pension projections and also run that cash flow analysis for you. But you can reach us at 1-800-900-5867, or you can reach us at info@theretirementgroup.com if you want to schedule a call or appointment with one of us. Also, if you got your cell phone out, just go and hold up to one of those QR codes. There's one to follow us on the LinkedIn page, and you can get directly to the Merck specific LinkedIn page, so you'll be updated on any new webinars we have coming out, and then also any interest rate updates and things like that, and how they can affect you. And if you'd like to schedule an appointment with myself or one of the other advisors in the retirement group offices, just go ahead and hold it up to that one. You can get into the scheduling system there and pull us up on our calendars and do so. But I do want to kind of wrap it up and again just remind everybody we've worked extensively with Merck, so we've got a deep understanding of the transition process. Our job's to hold your hand through that, and then hopefully if you need help beyond that, you throw our hat in the ring when it comes time for interviewing investment advisory firms. But again, we are not employed by nor are we endorsed by Merck. We've just been working with employees for quite some time and have a good understanding of it. So any questions, if you want to run any reviews, it's 1-800-900-5867. Thank you very much, and I hope you have a great day.